I most likely do not need to go over the reason as to why your Tesla holdings have dropped in price recently, but basically the Fed is finally admitting that inflation may not be transitory. What a surprise. Who would have thought that if you have low interest rates and print an absolute fortune, that perhaps prices might rise? Don't get me wrong, there's still a lot of issues with supply chains too, and shipping is still significantly more expensive. Not only that, but shipping takes longer, which means businesses require more working capital as their inventory is tied up for longer. Some businesses are passing on this cost to the end user, others are having to wear the costs themselves. But now the Fed is admitting we may actually have real inflation and are potentially intending to raise interest rates as a result. However, judging by the market's reaction, raising rates may not be an option for the Fed. It's clearly going to kill the economy. People will lose their houses and banks will go under. The issue is that government, or all governments, are stuck between a rock and a hard place right now. Inflation is running rampant, but they can't crash the economy. Not only that though, well, no other entity on the entire planet happens to have as much debt as the US government. The government also have to pay interest on their debt too. The interest on the public debt for fiscal year 2021 is estimated to be $413 billion, according to the Congressional Budget Office. If the Fed raise rates as much as they're indicating, then the interest payments will likely double. Of course, to pay for this interest will likely require more borrowing too, which will lead to more interest and more inflation. You get the point. A downward spiral of debt and inflation, and potentially hyperinflation. So the Fed are trying to prevent inflation within the economy, yet it will mean they also have to create more inflation, potentially trying to pay for their own interest due to the rising rates. You might think the government can use fiscal policy instead. This is part of MMT, modern monetary theory. They can raise taxes to slow down the economy, but for one, any tax rises won't bring in very much extra income, and most people are going to be struggling enough to make ends meet as it is. Hence why there is so much talk about taxing the likes of unrealized capital gains, of which Elon recently demonstrated the results of by selling some shares. Even when we had these record deliveries, we still didn't recover to where we were before Elon started selling his stock. Tax on unrealized gains will remove so much more value from the market than the actual tax that will be received, let alone the end result of how much actually gets spent once it's been through the government. But the government like to peddle the idea that there are these greedy billionaires that have taken all your money. Don't look at the government. We're here to help. We don't make mistakes. We haven't taken your money. Elon Musk has. Despite seeing senators flying on private jets with your tax dollars, the hypocrisy makes my head spin. Bear in mind, the average senator spends about 30 hours a week fundraising, and guess what? They're not charities. These donations that are given require something in return. Alright, so we just saw only the mention of rates make the markets freak out, especially tech stocks, namely Tesla. Ouch, that hurt, especially if you had options. So clearly, I don't think the government can really take this path. It could destroy the economy. But why are high interest rates bad for stocks? Well, for starters, the opportunity cost of investing compared to receiving interest on cash increases. If before you only received, e.g. 1% return, and then it becomes 2%, then the return is twice as good. So more money goes into the likes of bonds and savings accounts. This in turn affects the PE ratios of stocks. As you know, PE ratios are historically high. Obviously, if PE ratios reduce, then stock prices will also reduce accordingly, even if profits remain the same. But also, with higher rates, then money becomes more expensive, as in it becomes more expensive to borrow due to higher interest payments. Therefore, consumers are less inclined to spend, along with the opportunity cost of getting better rates in the bank. If consumer spending reduces, then they're buying fewer items. If fewer people are buying Teslas, then there will not be as much revenue for the company. Although I don't think fewer people will be buying Teslas. We'll go over that in another video. I just use that as an example. Obviously, if there is less revenue, then there is less profit for the company. With less profit, then the stock price reduces accordingly. With rate rises, eventually homeowners' mortgages come up for renewal. Then they have to renew their mortgages at a higher interest rate, and thus higher payments. This means they have less money to spend on consumption, which means businesses have less sales, less revenue, less profit, and a lower valuation. If businesses are making less profit, or even losses, then they have to downsize and lay off workers. These unemployed are then less likely to go and spend money in the economy, and thus business suffers even more. With all this adding up, higher mortgage payments and less employed, or others receiving pay cuts, then some homeowners simply can't afford to make their mortgage payments anymore and must be forced to sell their home. Unfortunately, they're not the only ones, and the property market enters a down cycle. If the property market crashes, then it's possible some people will simply walk away from their homes and the debt, as they may now be worth less than the actual debt. This in turn puts pressure on the banks. When there's pressure on the banks, people with savings are concerned the banks will go under and may withdraw some funds. However, the government in the US does insure up to $250,000 in deposits to avoid this. Also, the central banks help mitigate a run on the banks too. All of this could bring on a severe recession, as there'll be less money to go around. Investors sell their equities so they have enough money to live on if necessary. Anyway, that's why rising interest rates could be bad. But the market may continue to run, with ups and downs and continual scares, just like this, until it finally does crash. The bull goes up the stairs, the bear goes out the window. The question is, will this create the crash? Will the music finally stop? Or could this even just be a scare tactic of the Fed to keep inflation in check, as they know they can't afford to raise rates anyway? Personally, I think it's most likely the Fed are just testing the waters. Personally, I really didn't want to dip or anything right now, at least not for another month, until we had earnings come out, and hopefully the new factories with 4680 batteries. I have a lot riding on all of this at the moment, at least a lot relatively for myself. If it goes well, then I should make a good profit. I was then planning on purchasing my insurance against such a crash. As investors, we just have to establish whether this is a dip or this is the start of the recession. As Tesla investors, we also have a lot of wind about to enter the sails, with a lot of positive events about to come into fruition. But we see these ups and downs in the economy play all the time. We just experienced the Omicron scare only recently. Let's just be glad that Tesla only has about $10 billion of debt and not over $100 billion. Anyway, I was super bullish on Tesla's financials that I placed an order for another options contract and it executed. Unfortunately for me, I'm asleep during most of the time the market is open. I had put a lowball offer in on a February call option and it executed whilst I was asleep. I was unaware of the news that was happening. If that hadn't been the case, I likely would have waited it out. But sometimes this strategy also pays off, so I guess it balanced itself out. I mean, I've had a pretty good run. So far since I've been running this channel, every single trade I've done has won. I haven't bought one Tesla share either, just options. And despite this drop, all of them are still up, and still up a few %. I mean, surely, I can't expect to win them all. I still think I might be okay with this option though. There's still about a month until it expires and a lot of exciting times ahead for Tesla over that time. I mean, in addition to what I've already said, it feels like so many other facets of Tesla are also coming together. Don't forget, Tesla is much more than simply a car company. It's just that's mainly the side that we focus on, as currently that is literally where all the profits from the company are derived. The question is, do I buy another option? This looks to be a fairly substantial dip, but the stock price is not reflecting close to what the EPS is going to be. I think I need to start doing some preliminary expectations of the Q4 results and see what we can come up with. I was initially thinking 50 to 60% increase in profits from Q3, but I'm starting to think that perhaps the ASPs might be higher than I expected now, and maybe margins too. I get the impression that Shanghai Model Ys have really good margins, and that is mainly what we've been seeing ramp up the most this quarter. In addition to that, LFP batteries in Fremont, more Model S and X sales, and of course the price increases are starting to take effect. I think it might be prudent to do a bear, bull and base case even. This feels like a really important quarter, or maybe it's just extra intense for me as I don't think I've ever had so many options riding on them. If this dips further, I'm not sure what strategy to take. I have a bit of cash on hand at the moment. I can afford another shot at a contract. I'm just wondering if I take a gamble or go back to my old ways and buy another Leaps contract, probably around January 2014. Let me know in the comments what strategy all of you are thinking. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.